Our next speaker is Mark Ewing, who has produced a really interesting report about crowdfunding.
Thanks, Eddie. Hi, yeah, my name's Mark Ewing. I currently work as an FD for a subsidiary of a residential developer in London, which is completely unrelated. But a year ago, I finished an MBA, an exec MBA at Cass Business School, and through Eddie and other people, became very interested in crowdfunding as an area. And I did, as my final research project, did a piece of research on equity crowdfunding and how it interacts with business angel activity in the UK, and whether it's complementary to or substitutional to established practices of angel investing. So I'm just going to talk about what I was aiming to achieve, how I did it, a little bit, assuming a knowledge or lack of it here. I'm sure that most of you know a lot about business angels, an overview of what they do, an overview of equity crowdfunding as a sector, and then a quick look at some of the key players in the UK market, and then just look at, break down my research objectives and the findings there, and wrap up with some conclusions. So in terms of what I was proposing to achieve, I was looking to explore whether the new phenomenon of equity crowdfunding was in competition with or complementary to what angels traditionally do. Just to sort of recap for everyone's benefit, a definition of equity crowdfunding would be offering of shares or securities in private businesses to the public via an online platform. Those guys worked for Nesta on a report in 2012, which I found very useful, and an often used definition of who business angels are: be high net worths, investing their own capital in unquoted companies, not associated with their family and friends. So in terms of how I did it, it was tricky because statistically significant data samples were hard to get from platforms, commercially sensitive, also a young industry, and angels are, by their nature, quite secretive about their investment activity. So what I did instead was I looked at the literature, as you would expect for an academic piece of work. I looked at, and then I got qualitative data from interviewing a range of people connected with the sector. So those included angels themselves that I got in touch with, and the CEO of the UK Business Angels Association, who was very helpful. Equity crowdfund platform operators themselves, interested academics, industry experts and lobbyists, and then I got some quantitative data last summer from Seedrs and Crowdcube as well. So in terms of business angels, obviously they're a long-standing source of risk capital for growth companies in various developed markets. UK has the best developed angel market outside of the US, and there's a growing trend for syndication between angels, which is kind of mirroring patterns of behaviour further up the funding escalator, VC firms and other forms of PE. It helps plug the equity gap for unquoted companies. It's a valuable source of capital for those companies, and it's big business. 10 times the sums invested by VC firms are invested by angels in both the US and the UK relative to the VC markets in those countries. But the returns are, as you would expect, risky. It's a risky sector for investment. The returns are not normally distributed. A tiny minority of successful exits produce the vast majority of cash that angels derive. Average returns are about 2.2 times money over 3.6 years, which is about 22% IRR, which is not to be sniffed at, but it's a risky sector. And obviously, knowledge of the sector you're investing in and active involvement with the companies that you're investing in, if as an angel, increases the chances of good returns, which is not rocket science. The average UK angel would invest about 240,000 across 5 or 6 investments in their career. Okay, so equity crowdfunding. Obviously, it's a recent phenomenon, and it allows ordinary people, in inverted commas, to invest in unquoted companies for the first time. So as such, it's kind of democratizing what was previously quite an exclusive marketplace. It mainly provides seed and early stage growth capital to companies, and it also, I think, is fair to say it's providing lots of entrepreneurs with capital that they would not otherwise have been able to source. It's a classic example of digital technology kind of removing intermediaries and therefore reducing transaction costs. But as a result, the burden of kind of the due diligence for a lot of the investments that people are trying to make switches towards the crowd investors themselves and away from intermediaries that might otherwise have done the work in the past. So therefore, the risk for the investors using these platforms increases, along with kind of the resultant information asymmetry between themselves and the entrepreneurs that they're maybe looking to fund. The valuations are also usually set by the investee businesses rather than by the investors, which again is a deviation from traditionally what angels would do. And as a result, some platforms allow the level of equity offered to sort of flex along with the kind of supply and demand economic profile of a fundraising as it progresses online. One last thing on that point, as with private unquoted equity elsewhere, there's no functioning secondary marketplace yet, although there are platforms that are sort of offering a sophisticated introduction service. There's one called Liquidity, I think, which is growing in the UK at the moment. So in terms of a little bit more about equity crowdfunding, commissions raised typically are about 5% on funds raised. The UK market has grown rapidly as a result partly of the skill base and the regulatory environment that we have in the UK. Tax incentivization schemes such as EIS or SEIS are pretty crucial to the business model in terms of helping to attract people that are sheltering the capital invested against taxable income. And the platform market has started to differentiate along quite clear lines as far as I can see. One is the level of DD undertaken by the platforms themselves. Two is the level of minimum investment required and whether there's a threshold there or whether it's completely open access. Three is the sort of the route by which crowd investors can hold those shares, whether some platforms use a nominee structure and hold them on their behalf and vote on their behalf. Others allow them to have a shareholding direct in those companies. The voting and preemption rights and the classes of shares offered do differ, which is obviously crucial if you think about it. But perhaps many of the crowd investors are unaware of the differences there, which is a risk for them. Most platforms operate what's called an all or nothing model. Therefore, the entrepreneurs only get their funds if the threshold or target which they've set previously is achieved. Crowdfunding, I would say, the equity crowdfunding in particular is an invaluable tool to help validate business models for entrepreneurs. So to put your pitch up there, to put your business plan up there, it provides real, meaningful, live feedback from real people in the real world. Social media skills are obviously just as important, far more important through this platform than they would otherwise have been. As well as having a great plan, you've got to present it in a great way and do a great pitch. And platforms that kind of nurture their investor base, inform them, and sort of keep them up to date on their investments and new investments can create competitive advantage. Regulatory environment is changing. There has been a recent development where the FCA have said that if you're not accredited or sophisticated, then you shouldn't invest more than 10% of your investable assets in any one investment, and platforms are supposed to police that, which is an interesting change. So, some of the key sites, some of the more open access ones, familiar names, Crowdcube and Seeders. Crowdcube are probably the best well known, and they've raised £40 million to date. Further down, we've got Syndicate Room, which was very interesting to me. Gonzalo's here tonight, one of the founders, because that's predicated on angels leveraging crowd capital, but on investments that they've already done DD on and are proposing to invest in themselves. SeedUps and Crowdbank are other key sites. But let's move on. So one of my objectives was, can crowd money offer a genuinely new supply of risk capital for companies in the UK, unquoted companies? Time will obviously tell. But the signs are good. The level of investment went up 30% in 2012 compared to the previous year globally, $116 million. And I'm sure 2013 showed a similar pattern. Crowdcube raised 30 million in the year to last month, because when I was looking at it in August 13, they only raised 10. Syndicate Room have managed to raise £10 million for 18 businesses, I think I'm right in saying, since they launched in March 13, which is exponential growth. So the leading players are growing very quickly. And the vast majority of individual investments are below 5k. So I think it's fair to say that the majority of crowd investors are new to the business of investing in unquoted companies, and they provide the majority of the capital. So the differentiation between different platforms could result in different parts of the equity gap being addressed by different models. So you've got your open stroke retail models such as Crowdcube and Seeders against your restrictive or slightly more discerning models, perhaps such as Syndicate Room. So in terms of trying to represent that graphically, I found an interesting graphic from those guys from Nesta, just showing how equity crowdfunding could address a slightly different part of the risk-return profile to VCs and BAs. Okay, so the next objective I was looking at was, are angels actually channeling some of their capital through these platforms? Well, 40% of the total funds invested through Seeders and Crowdcube to August 13 were made through investments of over £5,000, which is kind of the lower end of the angel investment. Platform awareness was growing rapidly at the time through angels. Everyone I spoke to in the angel world was increasingly aware of it, as was, and the CEO of the UK Business Angels Association was able to attest to that. Syndicate Room's impressive start is obviously a key indicator of how interested angels are. And angels seem to be using platforms to diversify their investment risk and spread their bets, streamline their deal flow, and help identify opportunities that they obviously can approach subsequently offline. But obviously, as I was saying before, the voting and preemption rights attached to equities, they have to be right for angels because they're obviously more discerning and cute. So that is important. So platforms allow angels to leverage the passive capital of the crowd. And this could help or delay the need for VC funding further down the track, which is important because obviously VC sector consolidation means that VC firms are driving harder deals when they partner with angels, and that makes life harder for the angels concerned. So angels and the crowd investing together means that they can crystallize more value for themselves and cede less value later on to providers of PE capital further down the chain. Obviously a mutually beneficial thing. So can angels and the crowd plug a larger portion of the equity gap together than they could alone? Well, it's too early to tell for sure, but angels and the crowd might be targeting slightly different portions of the risk-reward profile. Research indicates that equity crowdfunding can be largely complementary to BA investment because crowd investors tend to be new to the market, and although platforms divert some angel capital online, they also allow angels to leverage crowd capital. But platforms also obviously provide competition for angels as a source of equity for entrepreneurs. Syndicate Room, as far as I'm aware at the moment, is the only UK business in the sector to explicitly target or showcase the combination of angel and crowd capital. So in terms of whether angels and crowd investors would work together and whether angels would be invested in doing that would depend on whether the amount sought is in the angel sweet spot, whether the industry sector is one that angels tend to favour, so that would be tech or clean tech as examples. Is the knowledge required deep and niche, or is it widespread and easily acquirable? And would the existing shareholder structure deter angels at all? Is the capitalisation table complex? What are the voting rights and preemption rights attached to it? I would say that platforms only really pose a threat to what I call soft angels who have got the money, but they don't really they're not able to provide the expertise, network, and mentoring along with that. And all the angels I spoke to believe that co-investment would help address the equity gap to some extent. Okay. I better keep going. So that's kind of another graphic representation, again from same guys, to show that the potential for crowdfunding, and I think that the scale of investments that have been going through Seeders recently in terms of raising nearly £2 million for a quoted wine business, Chapeldown Wine in the UK, and the level of investments that Syndicate Room have been facilitating shows that this has a lot of credence to it. So in terms of conclusions, I've got 1 minute 20 seconds to go. I just try to balance what the factors in terms of what made equity crowdfunding complementary to business angel activity and substitutional to it. So we can see that platforms attract new investors to the market. They allow angels to diversify their portfolios and place more bets. They arguably and hopefully allow both angels and the crowd to defer VC involvement, increases deal flow, leverage crowd capital, Gonzalo's business model is living proof of the complementary potential. So I thought that those factors, on balance, outweighed the substitutional factors in terms of diverting some money online from traditional angel patterns, basically the model is changing the balance of power between the entrepreneur and the investor, but hopefully in a mutually beneficial way. So the verdict was, on balance, complementary. Okay, thank you very much.
Okay, great. Can we get any questions for Mark?
Hi, Mark. You touched on the differentiation between platforms. When you were doing your study, did you notice any differences in terms of the kinds of projects that were different kinds of projects attracted to different platforms, or was it, or were they more uniform?
Well, I think that it's fair to say that the more open access models such as Crowdcube, and maybe to a lesser extent Seeders, because they do, I think, do a little bit more due diligence, they attract more of the product that would typically appeal to a retail investor. So there are more consumer-facing brands, I think, and this is generalization, being funded through those kind of platforms, whereas, for example, Gonzalo's platform, he'll be able to obviously add more detail there, but typically the more restrictive platforms would appetize or facilitate deals for businesses that were would normally appeal to the more discerning investor. So more B2B stuff, more tech stuff, and businesses that operate in fields where the knowledge required would be a bit more niche and a bit more specialized.
So I was wondering how much there's a concern that crowdfunding is perhaps a temporary thing from the retail market, in that is there a risk that people don't really know what they're getting into, and if they appreciate the risk is bigger than they thought, the interest in crowdfunding will go away? Or is it that in the low interest environment, and generally getting money from anywhere from your investment right now is difficult, and once that changes, the money will go away? I wonder what your thoughts are on that.
I think Gonzalo will echo this because we were talking about this beforehand, but I think it's clear that we're still in a very early stage here. So a lot of the businesses that have attracted crowdfunding capital so far are still growing. Some of them have gone to the wall, and there's been a lot of press about that and about how retail investors have caught a cold through that process. But I think a crucial part of the story here is in terms of the voting rights and the preemption rights attached to the shares that people are buying through these platforms, and also the mechanism through which their shares are held. So, for example, if you've got an open access platform such as Seeders, I think on balance it's preferable to have those held in a nominee structure such as Seeders do. And there's a lot, some good legal minds who work at Seeders, who are some of the founding guys at Seeders. So they understand corporate law, and they will be able to hopefully responsibly vote on behalf of a large group of investors with a small amount of capital in. Now, if you compare that to, say, Syndicate Room, the way they do it is that because the founding investor, the angel investor putting forward a project initially, is on the board of the company, typically, that receives the funding, they say that that will, I guess, achieve the same end in terms of representing the interests of the crowd. But if you have a lot of people investing small amounts of money in an unquoted company that does become successful, then if you know anything about private equity, there's a high chance that they could get diluted out the minute that an IPO or a large amount of private equity capital comes in from a VC firm or otherwise later on. And I think if we come to that stage, then it will be clear what the risks are of that model, and I think then the differentiation between platforms will become make far more sense to the ordinary man and woman in the street reading about it.
We've yet to see exactly what the results are of the crowdfunding model. These platforms spend a lot of time talking about how much they've raised, but not a lot of time talking about the success or failure rates of the companies that they've raised money for. Have you done any research into how successful or not these companies are?
The short answer to that is no, because I haven't had time, because I've had a day job since I finished my project. But I do know that from reading a lot of research as part of that project that, high growth companies that would make it as successful businesses in the real world constitute about 4% of total small companies that are formed every year. So if you extrapolate that, if you use that as a rule of thumb for companies that are funded at a seed and early stage growth stage through platforms, then that's not a bad rule of thumb to use, and therefore you can see that only 4% of these businesses will be, if you like, high growth and successful and attract a lot of positive media in the years to come. So that means that roughly 95-96% of these businesses either will fail or will simply become, relatively successful but reasonably mediocre businesses in comparison to all of the real success stories that get hyped so much in the media. So that fact, if you want to use that extrapolation as a rule of thumb, has, I guess, big implications for the next 5 or 10 years for how crowdfunding works out. Yeah, it's early days yet. That's clear.
Hi there. Yeah, just a quick one. Did you do any work on the sort of typical investor profile on this? And really what I'm interested in is, are these people who are putting in money just as a punt, happy to write it off, it may well turn into something if it does great, if not, well, so what, it was fun, yeah. Or are the people typically expecting some sort of return out of it?
Well, I think for the average retail investor, their motivations are different, and they often back companies to a small extent because of a passion for that particular sector, or because they may know the people involved, or they believe particularly in the mission that a particular company has. But I wasn't necessarily concentrating on crowd investors particularly, I was looking at angels, and I think that there was a pattern emerging from talking to, say, the CEO of the UK Business Angels Association, where she was increasingly hearing of angels. Say if they had £100,000 to invest in private equity, small unquoted companies, they were maybe parcelling up 10% of that, and then spreading that 10% over placing multiple bets, if you like, online on a range of companies that they found interesting, so that rather than making, say, 5 investments of £20,000 each, they were making 3 or 4 of those investments of that sort of nature, and then spreading the rest of their money over a wider range of businesses on platforms. Yeah.
Okay, Mark, thank you very much.
Thank you.